Good morning, everybody. Thanks for taking the time on Saturday morning for joining us for this exciting opportunity that we're going to be sharing with you today. And many of you already know me. My name is Vinki Lumba. I'm a founder of Lumba Investment Group. I have a strong IT and academia background. I have also done some commercial real estate in my previous life, but fast forward, now I'm doing the same thing. At current, my focus is commercial real estate investing, and special focus is on multifamily as well as the self-storage. And I'm always looking to connect with investor partners. Today, we'll be discussing the Delta Drive Storage self-storage deal. It's an exciting Class A ground up opportunity. And I have my business partner on this deal, Himal Bidyani. He's gonna be walking us through this deal, and it's gonna be question answer format. I'm gonna be the investor, so I'm gonna ask as many questions I can, and Himal will be address it. And as we go through, if you have any questions, please put your questions in the chat box. We'll try to address all your questions. Before we get started, I'm gonna go through a small little disclaimer. This session is strictly for educational purposes, or I would say the knowledge sharing purpose, and should not be considered as a legal, accounting, or an investment advice. This session does not represent an offer to sell or a solicitation an offer to purchase an investment or a security. The strategies mentioned in this presentation may not be applicable for everyone. So please consult your CPAs, your attorneys for any tax or investment related situations that you have. Once again, this session is strictly for knowledge sharing purposes. Some housekeeping items. Please use the Q&A box for any questions instead of chat box, because questions tend to get lost in the chat box. I will try to address all your questions like I mentioned earlier. This webinar will be recorded, and recording will be sent out to everybody. Please make sure to whitelist my email so that it does not end up in your spam. Actually, one more thing. If you wanted to reach out to me, you can send an email to vinki@lumbainvest.com. Himo?
Yes, thank you for having me here. And I'm excited to share this project with everyone who's joined on this Saturday afternoon.
That's true. I mean, I'm super excited to share this exciting deal with everybody. So would you like to share your screen, or would you like me to share?
No, let me share my screen.
Let's do it in a question answer format so that we can walk them through the complete deal, as well as we can do it in a format that the questions are answered. So the way I wanted to start it, I would like you to tell us about your team, who you are, and your history at present, where you are.
Yep, I'll put the pretty little faces of our team first here. So we are a team of 8, now going to 9 people as part of Exponential Equity and Exponential Development as a brand. So my personal history, I came from the management consulting realm, worked with across 3 continents in a management consulting firm for 15 years. Then went into the strategy side of the financial business. So I was with Wells Fargo, senior vice president there. And over the last few years, I've opened up a bunch of businesses, outsourcing firm, private lending firm, residential real estate, and then moved to commercial right before COVID hit. And over the last 2 years, we've been able to build a company that is now 9 people strong, close to $100 million in assets under management across 4 states. We are primarily in multifamily and self-storage as an asset class, both from an acquisition standpoint and development standpoint. So we have the acquisitions division that's led by Casey Koenig, and then the development division is led by Brandon Maxwell, who you see here. He had a residential development firm doing service for multifamily, for storage, for office, all kinds of work in the Charlotte area. And when he was looking to expand his company, and we started talking, he actually sold off his firm and joined us as the head of new development. So we are excited to have him last year, and he's been instrumental in bringing that construction management, project management, city navigation, all the builders permits, all the stitching together of the team to put in the work that is needed for a development project such as this. And then lastly, Yomesh comes from a corporate background. He's the CEO of the firm and our other partner as well. And he basically is in charge of all our operational parts of the business. We are expanding into property management. We're going vertical for all the close to 1,000 units that we own. And Yomesh is instrumental in building that portfolio and managing that portfolio for us.
Great. And now we join hands with you, Lumba Investment Group.
Yep.
I'm super excited to be part of your team.
Yep.
Anyways, the next question I have for you is how and why did you come up with the self-storage idea, or why your pivot to self-storage?
Yeah, so the macroeconomic trends we are seeing around employment. So if you've read the job report yesterday itself, there's 4 million Americans that have quit the workforce, right? So finding people, good people to work in any business is going to be harder and harder. That's just a fact across the globe, right? With rising inflation, childcare and other capabilities, a lot of people retiring, a lot of people looking at alternative investments and crypto, and so the workforce would be thinner and thinner. And multifamily as a business, we love it. But it's intensive in terms of management. A size of the property that we're building here, if it was a multifamily investment, it just takes 5 to 6 people, leasing agents, maintenance staff, etc., to run that property. So self-storage, has very much similarities to multifamily, but also is a very simple asset class compared to multifamily in terms of building it, because it's literally boxes, and HVAC for climate control. And also from a maintenance standpoint, the level of automation self-storage has seen is just phenomenal, right? You can have an access control pad. People can just come in, drive through. You don't even need a person nowadays. They're setting up virtual desks in some of these storage facilities. So you can video call a person. You can book your storage facility through an app. And very little maintenance is needed, cleaning out the place, trash, etc. So there's a very much less in terms of employment. So that's one big positive factor for the future of the economy. And the second thing is just maintenance wise, right? Again, it's just a box, right? So there's less of physical maintenance and there's less of management maintenance. You don't have tenant evictions laws. If somebody doesn't pay the bill, there's an app to just lock their door and sell their goods in an auction. So those all elements allow us to operate much more efficiently, especially when we build and expand our property management company, to bring all that in-house and really run a lean and mean machine of having multiple self-storage and multifamily facilities across the Carolinas that we can run and manage. So that's why we are excited about this asset class. We'll be building many more self-storage facilities and buying many more self-storage facilities, especially in the Carolinas, where the climate is just phenomenal.
So you think your past experiences kind of transferred into this new asset class and it's working well for you?
Yeah, we worked with many operators in the past with self-storage. Brandon brings a lot of self-storage and multifamily construction experience as well. So all that allows us, along with a very simple asset class, it's a very sticky tenant, right? It's like a Netflix subscription almost. Once the tenant is in, they don't bother. They typically stay there for 1 to 3 years. They don't bother canceling their storage subscription. They don't want to move all that stuff around. And frankly, Americans just want to store stuff, right? And we have found that millennials now, rather than having less stuff, they want to store more stuff because they want to live a lifestyle experience. They want to move around quite a bit. And this type of storage, ancillary storage facilities on top of wherever they're staying, allows them to have that flexibility and lifestyle that they very much desire and would continue to do so in the future. So we are very bullish on this storage market, and we'll be going very aggressive in it.
So what I'm hearing is you're saying is comparatively low maintenance. When I say if I compare to the multifamily or any other asset class, self-storage is pretty low maintenance. Do you agree on that? I mean, that's what I'm hearing you saying that.
Absolutely. Maintenance expense on a B to C class multifamily is typically 50% of your income. That's what you underwrite to. In a storage facility, an old storage facility, even your maintenance expense is around 35%. So dollar for dollar, you just have a much more profitability metric in the storage space than a multifamily space.
Great. So tell us, what makes this Delta Drive storage so lucrative or that exciting deal that people invest in that?
Yeah, several reasons, right? So if you haven't heard about the Charlotte market, one of the top markets in the entire country, just like Dallas, just like Phoenix, the Carolinas are just exploding. Right in Charlotte, there are about 250 people that have been moving. The city is about 16 years behind in terms of their plans in accommodating all these folks, and that growth is just going to explode and continue. So as with any major city, there are sub-markets that are coming up. And one of the hottest sub-markets that has come up, and I'll show it over here, is Gaston County in Gastonia, where we are. So, you know, I won't go through the key demographics of Charlotte, but Gastonia, if you research this sub-market, it's the second largest county, Gaston County. That's where this main city resides in. And Charlotte, the city of Charlotte and the city of Gastonia decided over 18 months or 2 years back to actually build a light rail, even though it's only 35 minutes from downtown Charlotte, to build a light rail from the north side of Charlotte down to Gastonia for allowing for public transport expansion. And that just blew the Gastonia market in terms of people moving there, and then jobs moving there, a lot of companies moving there. And obviously, when all that happens, they would need some storage space. So that's where we are in. So when we did the research for this market and this facility, especially, everything around it except one facility is 100% occupied. So when you think about just strong demand of a place where no more storage is coming, as we know it, everything is 100% occupied. That means there is just super demand that you can actually increase the prices, you can actually build something new, and it takes a while to get, you know, the zoning approval. We've been working with this land for 7 months, and now recently got the zoning approval to move forward with building permits and everything. So it's not an easy place to build, obviously, just like every place else. And when you get to build something in a place with unbelievable demand, you just have a very good metric to succeed.
Actually, can you walk us through your research, the market research? I know you have a bunch of slides on that. If you can walk us through that whole thing.
Yeah, absolutely. So I'll kind of talk through it a little bit as well. So location overview. This is one of the bigger corridors, I-85, that goes through Charlotte and goes south. And the Delta Drive facility is right here. And this is all the stuff that is coming up with residential houses. There are a couple of thousand houses coming just around here. And the best benefit to us is 1 million square foot of industrial building is coming literally across the street from Delta Drive storage. So that allows us, and I'll show you how we've kind of divided the land to make sure that we have a diversified income. And we have, future room for expansion with that diversification as well. But this allows us to not only bring the residential customers that are coming up here, but also the commercial customers that will be looking at, hauling their tractors or putting more goods, additional goods into their facility that won't be here in the industrial building, the Class A industrial building that's coming up here in 3 months or so, about to be complete. And that's why we love this location. And what we did with this, unlike a multifamily where you just look at rent comps and the neighboring multifamily facilities, that how they are performing, in the storage space, you can create or ask for an expert's opinion in terms of a feasibility study. So we hired the storage experts to actually create a 150, 175 page document on whether this facility would be successful or not, and what are the pros and cons of investing or building something here. So that 175 page document, and we are happy to share that as a feasibility study, that's something where when they take a piece of land, 70% of the time, they just reject that piece of land. So they say this is not a great site for storage. You should not be building here because of whatever the reasons are, right? Now, whether the land itself is not right, or the market around it doesn't have demand, or more buildings are coming, or whatever the case may be. Through their study, they would just cut off 70%. And out of the 30% of the land that they do pass, they give it an A to F rating. And so our facility, this land has got an A rating. So basically it's, top 5% of any facility that's going to be built in the Americas based on that rating. And that's what makes it just phenomenal for us to invest here and put that market. So that's the other thing I wanted to mention. But going to the actual research, right? When we looked at the piece of land, it's very flat. It's 6 acres of land. And what we're doing is for the 3 acres, we're building this 75,000 plus square foot facility, which you can see here in the pink or salmon color. And we'll, as we go work with the city, 75,000 could be 85,000 or 90,000. We want to pack in as much as we can, make it less than 100,000 square foot, because that's going to add more complexities in terms of city requirements, etc. But we want to make the most use out of the 3 acres that we have. And the other 3 acres that we have here, we want to keep that as RV storage and generate that additional 50, 60,000 in income on a monthly basis. And what this would do is leave meat on the table for our future expansion. If we, choose to, we say, hey, this filled out in a year's time and everything still is 100% occupied, there might be some need for dry storage or even a climate control facility. Well, the good news is this site is already zoned for that, and so the approvals are there. Or if we decide to sell this facility at a later date, and whoever buys it, they want to build something on it, this ground would be basically graded and with gravel in there, earning us a lot of income, not any investment to put in, and allows us to charge that premium if we go to sell it because of the potential of this facility that will be available.
Great. I mean, that looks so exciting. So tell us more about this opportunity. Go a little bit in more details. Tell us the numbers and what it's going to look like when the project is done.
Yeah, absolutely. So the property would be, like I said, we're right now looking at around 75,000 square feet. We want to be around 75 to 90. And depending on that, we would either have, 700 plus to 800 plus units, climate controlled, over 3 floors. That's the optimal mix that you want. And when you add a 4th floor, obviously that adds more fire hydrants and sprinklers and a lot more in the $10 a square foot in terms of cost to the project, which we don't want. So overall cost per project is around $100 a square feet, give or take, as we kind of bake out the final construction documents, city requirements will go there. Right now, if you think about REITs buy Class A facilities at about $300 to $350 a square foot. So if a REIT likes this project, the investment would triple in terms of returns automatically. That's the going in price. Now, 18 months from now or 2 years from now, whether that's the case or not, we don't want to work with that. And I'll talk why we want to keep this as a long-term investment rather than just flip it to a REIT, which is appealing to us. But then going into the unit mix, we want to make sure, based on the research of the feasibility study again, they have recommended by making phone calls to all the other facilities. What's the unit mix that they are putting forward? What are the rents that they are putting forward? And how much should we charge? They've kind of come up with a game plan that we've taken their recommendation, and we're putting in this. If we had 710 units, which is what 75,000 square foot would bring us, the mix would be pretty even in terms of very small 5x5, 5x10 to a 10x20. And I'll show you why this is a measure for success as well. Our rent per square feet is 1.36 on an average. Keep that number in mind, because as we look at the other comp of CubeSmart, that is the only climate control facility that's out there right now around us. Their numbers are way, way higher, and they are 90+% occupancy already, and managing that very healthily. So when we come in, ideally from an underwriting standpoint, we should match their numbers, but we are coming at a very conservative number because we want to lease it up as fast as possible, start earning that money, and then bring it home. So going into the returns.
Can I stop you for a second here? You were
Sure.
talking about the climate control facility. So can you tell us what exactly you mean by the climate control facility? Because you do not need the heating or air conditioning in the storage units, do you?
Yeah, so not inside the storage units. There are two types of facilities. There's the dry self-storage facility. So if you think about a single story structure, typically that you see out in mom and pop storage facilities that you have out there, where you can just enter in a single story and go in the ground. Typically, those are your dry storage facilities. So they're just boxes, essentially. You're putting in a pod in a structured fashion. There's no, so you can store stuff there, but the actual inside climate is not controlled in terms of heating or temperature. So the longevity of stuff, unless you store durable stuff, tires or cars or things like that, some of your goods, the longevity would be that great. So there is an appeal to have what is known as a climate control facility, so that you have your HVAC unit and maintain a certain climate inside the overall building structure or the units, which you can switch on and off. So when we build 3 floors, you can have one floor just switch off that climate control piece and you sell it as a dry storage. But our feasibility study research shows that this area requires, because of the demographic and the type of people moving in, the jobs and the household income that's coming in, they like that climate control type of arrangement rather than the dry storage facility. And that's what we're building here.
Great.
All right. What else should I?
So just take us through the deal. Show us the numbers, what it looks like.
Yeah, absolutely. That's the exciting part.
And then you had the slide up there to why Charlotte. You gave us a little bit overview of the Gastonia, why you picked this location, because you think this is a very lucrative area because there's a lot of population and more need for the storage units in the area. And then you think this is the best place to be in.
Yeah, Charlotte, it's now 35 out of global 2000 are headquartered here. So think about everybody from Electrolux's North American headquarters to insurance companies, to, if you think about bubble wrap, Sealy, the group that makes bubble wrap globally, is headquartered here. You won't believe the number of companies, along with, Bank of America, one of the largest banks in the world, Wells Fargo's Eastern headquarters, BB&T. So there's a lot of financial element, there's a lot of manufacturing element, there's a lot of university and educational element with Charlotte, and it just mushroomed in growth. And it's at the tip of North and South Carolina. So what Charlotte enjoys is, the expansion into South Carolina with even lower taxes than North Carolina. And then North Carolina and the vicinity it has to Raleigh-Durham, the international airport it has, Eastern flights to Europe are direct flights. So it was just a strategic location that over the last 20 years has been just booming pretty amazingly and not going to stop, in our opinion. So anything we like to buy here, even with this kind of growth, we want to make sure we start at the beginning of the life cycle. So every deal that we typically put forward, we actually get the land that is raw, that allows us to buy the land at a discount. So this land, retail value is about 1.5 to 1.4 million. We bought it for 1 million. As we rezoned it, contingent upon rezoning, we put in our own funds to rezone that land. And that gives us that advantage right from the beginning of the project, that we're buying something that if we just sell it off in a month, it will be worth more than what we bought it for. And that's where we want to start with our submarket expertise, our partnerships that I'll go through with Metrolina, Overcash, Demet, the great big wigs in the storage industry, is going to make us not only a project that works in terms of filling it up in all the units, but eventually when we go to sell it, we want to keep those REITs and the big companies in mind, because this is a Class A product. We want to make sure that we sell it to the CubeSmarts of the world, or Public Storages of the world, or a private equity firm that's just looking to buy things at a premium, which Charlotte commands right now.
Right. So can you walk us through the deal, the numbers? That's what everybody's waiting for.
Yeah, absolutely. Absolutely. So but just wanted to highlight before I go into the numbers, the one thing that I had here, Delta Drive versus CubeSmart. So CubeSmart is about 90% occupied, and their highest rent is around that 328. Ours is highest, the same size unit is about 266. So about $80 difference is what we are looking at. We obviously want to charge 328 and beyond, but that's the contingency that we've built in our plan against CubeSmart to make sure that we tap into their market as well, along with the tremendous growth that this city is seeing. So let me go to the deal first. So we are looking at about an 8.7 million. This is again subject to change once we start building the construction documents, the city permit, etc. Right now, the deal stands at 8.7 million in terms of overall cost for the project, in terms of development, and I'll go through the details. Out of which, we are getting quotes on 90% loan to cost in terms of a loan, a small business loan from a bank in North Carolina that's just bullish on this project. But it's a recourse loan. So I and my partners are personally guaranteeing this. And the project's not successful, it's my house on the line. So which is a pretty big deal for us, and that's a more incentive for us, and should be more rewarding for the investors, knowing that we will have sleepless nights making sure this project is successful, given the recourse nature of the loan. But we've assumed that 80% loan for now over here, rather than the 90% that we are getting quotes on, 3 years interest only. And then the other 2 million, including contingency and all the metrics for having that interest only period covered, we want to keep that equity piece. So we're raising about 2.2 million in equity. And we'll use that, like I mentioned, $1 million goes into the land. We're buying the land pretty soon. Officially, we have it under contracts in 7 months. And then hard cost, which is essentially your horizontal construction, grading, deforestation, stormwater, all of that needs to be done. And then the vertical construction of the 3 floors, along with the metal, the doors, etc., etc. The soft cost includes the architectural fees, the marketing expense when we start pre-leasing these units 6 months into the project, all the civil engineer fees, working with the building permits, etc., and our developer fees. And then the carry cost is essentially interest for the 3 years interest only that we would be keeping in place. So that's kind of the 8.7 million. And at stabilization, we want to have that revenue, or when we go to refinance this is not complete stabilization of 96%, which is what Charlotte market commands in terms of storage right now. This is closer to 88% that we've assumed. We'll have a revenue stream of 1.1 million or 1.2 million, closer to that. Operating expenses will be super low. The new build, nothing to Hopefully nothing should break down at all. And that would, allow us a net operating income about 850,000. We'll keep CapEx just like we do in the multifamily space. We want to keep a reserve account for all the capital expenditures. And that would generate a cash flow of about 825,000 from operations when we go to refinance. And right now, Class A is around 5 to 5.25 cap. So this is 1% more, which is super conservative in any given terms in 3 years. That we put in as a cap rate, 6.25 cap. We want to refinance this project, assuming this cap rate, assuming this income and the cash flow. And that would bring the valuation at 13.46 million, and which is 18,000 per unit, or 18,000, close to 19,000 per unit. And what we'll do is, out of the 13,000, I'll go to the next slide. At 80%, this is 80 to 85% is just the norm with self-storage, refinance deals, or existing asset deals. The valuation again is going to be 13.4 million, 46 million. We'll have a refinance proceed of 80% of that 13.46, which is 10 million, 10.7. Out of that, we'll first pay the bank and all our investor capital back, the 2.2 million that we had, that's that 8.7 million we'll pay back. And that would leave a profit of about 2 million once we have done that. And we'll distribute that 70-30, 70% for our investors and 30% for the GP. So the GPs, except the developer fee, which, is Brandon's team running around on a daily, weekly basis to make sure that, the construction site is doing what it should, and the site supervisors, all the construction element, paying for their salaries. The GPs would not earn a dime out of this project, essentially, until this refinance event happens. So that's a pretty big. So we're taking the highest risk in terms of a recourse loan, and we're putting all our incentives, almost all of it, at the back end with a refinance event, in knowing that this asset would be a successful one that we can buy and hold for a long, long time. So let me pause here to see what questions anyone has, and I can go into other timeline and other numbers as well, or details about how you're spending the construction budget, etc.
Yeah, please go through the timeline, show us the current timeline.
Yep. Let me talk about this first.
Yes.
So what does that mean in terms of a Class A investor? So if you put $100,000 in that $2.2 million pot, a 70-30 split would mean 18 to 22% annualized returns over a 3.5-year investment. We are not counting a single dime out of the lease-up period, whatever money we will earn during the lease-up period in terms of cash flow. We're not counting any of that. So this is just saying, when we refinance, that's the only time you're getting paid. What would that look like? So again, very conservative. 18 to 22% in annualized returns, 3.5 years. So 100,000, let's say we put it at 20%, $100,000 investment would bring back 170,000 at that 20% marker as an average year. And you will have equity in perpetuity for that deal. So after the refinance event is done, after you've returned back 170,000 on your $100,000 investment, you will enjoy splits from all the cash flow and the eventual sale of the property in perpetuity. So all that is gravy, free, free money basically, that you would have, you can invest your own capital return in another investment. The only hurdle we have put here, just as a disclaimer, is 50-50 after your money is doubled. And the reason is, while this is our plan A, we want to keep this investment for a very long period of time, knowing where the Charlotte market is going, and having a cash flow asset that we've essentially paid off at the refinance event, and making it free for all of us would be a great asset. But if a REIT comes and says, hey, you guys made this for 8.7 million, we would like to pay 25 million at, or 18 million or 20 million at, just when you built it and you haven't leased it up. At that stage, everybody's investment would triple, quadruple, whatever that return is, will be exponential return, which we aim to have as our company. We might not be able to say no to that, right? And if that kind of deal structure can be agreed upon, as GPs, given that we've taken all the risk with the recourse loan and we're paying ourselves at the back end with no fees in the middle, we'd like to be incentivized with that kind of structure. So that's why after your money is doubled, say $100,000 gives you back $200,000, then every cent or every dollar earned would be split 50-50 between the GPs and the LPs.
Wow, I like that. That's so good. So basically, you're doing the catch up, right? Because the investors who are used to investing in multifamily or the other asset class, they're used to seeing the returns every every quarter or a monthly, or maybe once they invest in the project, they wait 6 months when the asset is stabilized, they start seeing the returns. But here, since it's a ground up, they're not seeing the returns for 3 years or 3.5 year mark. But after the 3.5 year mark, they are just 100% return of the initial capital plus the 70%. That's the catch up. That's a 20% yearly return.
Right.
Wow, I love that. Thank you so much. So let me ask you one question here that came to my mind was, so you ran the comps in the storage area. You showed us earlier the slide. So you mentioned something that you wanted to go a little bit conservative on rent side. You might not want to charge the same market rent. And what is the theory behind that? If you can mention that.
Yeah, no, it's twofold. One is from an underwriting standpoint, there are about 4 or 5 levers that we can keep in to make sure that we under promise and over deliver on this, right? First lever is the debt side. So we have assumed 80% loan to cost, 4.5% interest, while we already got a quote at 3.75% interest and 90% loan to cost. Second lever is we assume that we would not be paying anyone for 3.5 years, even though as we lease up, the property would start paying cash flow. And so any cash flow that we can split 70-30 would be an additional bonus that will allow you to earn your returns faster. And just like that, we want to assume that we can start day one with marketing the same rents as CubeSmart, but given that our building would be empty day one, we want to pre-lease as many as possible. And we even went to CubeSmart and said, hey, if you wanted this second facility, what would it take you to lease this up? And they gave us a lease up period of 18 months to go to 94%, that fast. And we put in 2 years to lease up to that 96% Charlotte market stabilization. Well, initially, we want to provide that incentive to anyone walking in the door, anyone calling our call center, anyone going into our app or shopping around. Because storage is something that you don't sit around on a sofa and say, hey, let me see what the price of storage 10 by 10 is today in the Gastonia market, right? It's something that you need then and there, and you quickly make decisions on the storage side. And we don't want to leave any customer behind in the initial stage, because we have 700 to 800 units to ramp up. And the faster we can ramp up those units, the maintenance costs, the person who will come to clean things up, all those baseline costs are going to be always equal. The faster we can go to 90-95% and then increase the revenue through market rents would be a better strategy.
Good, thanks. There's another question in the chat. It's what's the cost segregation estimate for 2020 and beyond?
Yeah, so 2022 we'll have on this one, because it's a new build, we'll have an 100% bonus depreciation because of this project will finish in 2022. And so the cost segregation study would be done on the new build side once the project is complete. And that's something that will be done. So in 2022, $100,000 investment is estimated to give $100,000 in bonus depreciation.
Great. So can you tell us about the Metrolina builders, that you partner with on this deal?
Yeah.
And how good they are in the self-storage?
Yep. So 2 partners I'll mention. The third one is equally important, the civil engineer guys. But Firstly, our general contractors, Metrolina builders, fourth generation Charlotte-based builders of self-storage and multifamily. So they're helping us with our multifamily projects and our storage projects. And they have built pretty much every brand that you could think of: Morningstar, Public Storage, Life Storage, Extra Space, Be Safe Storage, Slate Storage in and around the Carolinas. So they have about 30 transactions. They have built 30 buildings in the storage world, and most of them climate control. So they know a thing or two, and Matt Williams and team are just on top of their game in terms of what makes storage facilities tick, what kind of options the city needs, right? How many windows to show outside to appease the county, just like here, versus everything be kind of boxed up. What would be the best resale value if you build a corridor like this or not? All of those design discussions that you need to have that end in mind when you eventually sell this facility, Metrolina is just an expert on. So that in itself has boosted our team, along with Brandon's experience in construction, to know that this facility and the project would be finished way before time that what we have projected. And I'll tell you why in the timeline part as well. But before that, the other piece of the puzzle is overcash demit. So if you go to any large, especially there's a storage conference in Las Vegas, Stephen Overcash, he's been in the business for 35 plus years, is the founder of Overcash Demit, and basically the architect of choice for all the big storage developers, and always going to present, very knowledgeable in these big conferences, and the authority in terms of knowing what the storage trends are, where things are going, how things should be architected, what type of materials are now coming along, given steel prices, all the other macroeconomic changes that are happening. So again, having them as partner rather than any just local crew of architects that would design a building allows us to have that another sounding board of building something that's truly going to garner attention for REITs and private equity firms when we go to sell it.
Great. So are you going to walk us the timeline?
Yep, absolutely. So this is our timeline. Again, I'll talk about the contingency pieces as well into it. We've already started work on the construction documents, the builder permits, working with the city to get a round of submission, get their comments. So we are way into this Q4 timeline over the last 2 months, knowing that the land has been rezoned. But formal acquisition of this land would happen as part of this raise of equity. We would not be putting in the debt on this till we have completed all the building permits and everything, and we are almost there in the horizontal construction phase. And the reason is the bank loan is 3 years of interest-only payments, and we don't want to start the meter until we are very close to starting the shovel breaking the ground. And that allows us those 3 years to completely lease up the facility. And if we do it faster, it allows us to refinance. But if you're slow for whatever reason, it allows us to have those 3 years of interest-only payments that we can easily pay. So land acquisition plus the builder's permits is slated to take 4 months. And we put in 6 months for that. We are 2 months into the project, so another 2 to 3 months, and we should have all the builder permits ready for this project and begin construction, the horizontal piece. The horizontal piece would take about, between horizontal and vertical, Metrolina has projected 10 months for overall construction. We have put in 12 months as the overall construction phase here, just to make sure we have another additional 2 months of contingency. So 2 months of contingency here, 2 months of contingency on this side. And then refinance would be, the lease-up period would be, like I mentioned, CubeSmart has put in 18 months as a projected lease-up, completely stabilized. We are putting in another 6 months of contingency there. So refinance would be done in around the Q2 to 2024. So we are putting in overall 3.5 year timeline, out of which about 10 months is contingency. So very, very conservative in terms of the timeline that we've put forward.
So if you're saying if you lease up 10 months earlier, you will have the room to refinance 10 months earlier?
Yep, exactly. Exactly.
Okay. Wow, that's interesting.
Yep.
Wow.
What
So
other
what is
questions?
what could be the hurdles in this timeline? You think, do you see any hurdles? Because that's the reason you put the 10 months contingency here. So
Yep. Yeah, development projects always have any sort of navigational complexities built in. And so we like to be ultra conservative in our timeline, right? The two biggest hurdles are the actual construction and the cost of construction that would move, right? And that's where construction timeline, adding those 4 months to the permitting process and the construction process would take care of that, along with incentivizing Metrolina to complete things on time. Once we get into the actual general contract with them, which lists out all the costs, the construction costs, which we'll share with our investors and our lending team. So they'll typically put a little bit more contingency on their construction costs. So if it takes 8.7 million, they'll put in 10 million so we can get a better debt structure, lower weighted average cost of capital, less money for investors to put in, and enjoy higher returns, frankly, for that reason. And then the second thing is just the lease up period, right? So we've actually shopped this around with 3 property management firms. All of them have given us that 18 months timeline. But let's say if it takes 24 months or even 30 months, that could be the big hurdle. And instead of 94% occupied or 88% occupied, when we have to have a refinance, we might be 80% occupied. Well, the good news is the way the construction and the valuation of storage is, we are assuming this is at 6.25. If it stays around that 5.5, you, even with 80% valuation, you have a very high sticker price to a project like this, A-class facility in Gastonia. And if it comes to a lower valuation, the GPs won't be incentivized to earn anything. The partners or the investors in the firm would be paid back first, along with the original loan, and whatever is left is going to be split 70-30. So it's in our benefit and our interest to make sure that we work really hard during this 3.5-year period to ensure that this project is a phenomenal success, gets to a very high stabilized value as soon as possible.
wow, that's really I would say a very, very solid plan and very doable as well. Thank you so much for sharing that. Let me remind our participants or the viewers, if you have any questions, please put it in the Q&A box, and I will also check the social media if there's any questions. But by the time, can you tell us what is the one best thing you like about this deal? I know you love this deal. I can see how passionate you are, the way you're talking and the way you're describing everything, but one best thing that, you like the most about this deal.
Yeah, I like the fact that the land itself is giving us so much value, A, at the discount, B, the diversification of income. So we're building the storage side and the RV storage side, which is a phenomenal source of income nowadays, with people traveling a lot and putting things, in their RVs to live that lifestyle, post-COVID lifestyle. So that allows us to create just smart income, buying the land at a discount, creating a smart income, and leaving room for some future growth. That's just a phenomenal business plan from my perspective.
Wow, that's great. And one worst thing that could go wrong, and you already told us kind of, about the lease up that could delay it, and then the returns could be delayed a little bit. But other than that, you do not see any big hurdles or any showstoppers, do you?
Yeah, I mean, market price of materials is always a challenge, and that's why we built in so much contingency, and we are waiting for the actual, when Metrolina would give us the eventual contract with the construction cost, their contract is not to exceed a price. And that's the price we'll take to the bank and say, Metrolina says, whatever happens to steel cost or any door cost, this project would not exceed construction of $10 million. And that allows us that assurity, allows the bank to say, hey, okay, it's $10 million as a cost. We'll give you $8.5 or $9 million in debt. Here you go. And that's the piece that allows us to have much more surety of the plan later down in a month or 2 or 3 months than where we are right now. So that's the piece we want to solve for.
Wow, that's great. So there's another question in the chat box from Rakesh. He's asking how much is the fund subscribed? I think we are subscribed more than 50% already. Correct. It won't last very long. So please validate that, Himo. How much?
Yeah, I think we're at 70%, something like that, 65 or 70% subscribed based on that 2.2 million. Yeah, we should be hopefully closed in the next week or so.
Yeah, it's gonna fill up really fast because it's a very, very strong, a very lucrative deal. I'm super excited about this deal. Can you show us one more time the slide? I think we missed that slide, Himo. The first one where we talk about why Charlotte. I think it's in the beginning.
Yeah, absolutely.
Well, this one, why storage, self-storage.
Oh yeah, of course. So yeah, I mean, I was just in a self-storage, North Carolina self-storage conference earlier in the week, Monday and Tuesday. And they were, Marcus and Millichap was presenting even better numbers than this one. They are projecting that the storage, it's one of the fastest growing industries in the United States. Mm-hmm. And right now, 1 in 10 people store a unit. It's just amazing. And the national average occupancy is way better than multifamily. With Charlotte, they showed around that 94 to 96%. And the Charlotte cap rate they showed, which blew my mind, was around that 5% for A-class asset, which we are completely conservative in comparison to that. But what I like, again, I've mentioned some of this, is costs are low, delinquency process is superior, right? I have an app that if somebody doesn't pay on the 5th, this door is automatically locked. I don't have to send a person. I don't have to file an eviction with a judge, nothing. That's how the contract is built. And if on the 7th they decide to pay, another switch, and that door is unlocked and they can use their access code to access their goods. As easy as that. Minimal rent regulation, right? It's based on competition. CubeSmart is charging $326. Tomorrow they can charge $400 if the growth is high and everything around it is 100% full. There is no lower income housing or anything of that, rent caps, federal caps that you would see in multifamily. This was a big topic in that self-storage conference, right? Like I mentioned, they don't want even a manager to be there full time. All the big companies are moving towards, almost like a robot with a big iPad screen. Once you walk in, it's a virtual desk. They're like, hey, how can I help you? They're moving more people towards an app, virtual tours, which multifamily wants to do with smart locks and other things, but has been unable to do or justify the ROI. While in storage, it's just the norm. And then demand projections, right? Not only nationally, but I explained how in Gastonia, when something around you is 100% full all the time and nothing else is coming new in the market, now that's a good place to buy or build.
Wow, that's great. And it looks so nice. So it's going to look exactly like this.
Oh, these are pictures to show. Yeah, but it interior looks like this pretty much. It's hallways, different doors. People, use an app or a call center or walk in the office. They get shown a unit depending on the size they want. We start with the upper floors first because the down first floor is the premium floor and you charge a little bit more in rent. And you start filling these up and you show them, hey, what kind of furniture, what kind of things you want to store. You start with those questions. And it's a sales process. So having someone who's established in sales, whether it's a call center that our property management partners would be using or apps, a lot of SEO and marketing goes on their website to ensure that we'll be releasing this up as fast as possible.
Great. Let me remind our participants to, if you have any questions, please put it in the Q&A box and we'll try to answer all your questions live. I mean, the reason we have it in the question answer format, the session, so that we can address all the questions, whatever we can possibly think of as an investor. So, but if you have any questions, please put it in the Q&A right now and we'll address that. But Hemal, I wanted to ask you, if somebody wants to subscribe to this investment, how do they do that? Can you walk us through that too?
Yeah, absolutely. This is a 506C, C for Charlie investment. So it is for accredited investors only. And so you would require, if you're investing with us or Vinki for the first time, an accredited investor certificate. But you basically connect with Vinki to ensure that she could walk you through the subscription process. We have a highly automated portal that we used, just like all the other big developers. Where you'll have a seamless experience in terms of looking at all the legal documents, e-signing them very quickly, and that's when my team would look at the subscription documents, all the signatures, the accredited investor certificate that allows us to verify and stay in compliance with the SEC for such an investment. And at that stage, you'd be wiring the funds. And for development projects, we provide a quarterly communication or any other milestone communication. For existing projects, we provide a monthly operational report and a quarterly financial statement. So for the construction period, there will be less happening on a monthly basis. But once this is finished and it gets into the lease-up period, then we'll transform into a monthly communication to say, this is how much we've leased up, this is the occupancy, these are the metrics, challenges, et cetera, et cetera.
I'm going to ask one more time. If you have any questions, please put it in the Q&A box. If you do not think of any questions right now, fine. If something comes up in your mind later on, please go ahead and send me an email. Can I share my screen for a second, Himo?
Yeah, absolutely.
Let me share my contact information. Here is my contact information. You can reach out to me. You can send me an email at lumbainvest.com, vinki@lumbainvest.com, or you can connect with me at LinkedIn as well. This is it, Hemal, or do you have any last piece of advice for our investors or anything that you like to share about the deal overall?
No, I just want to thank everyone who took the time to listen into this. Hopefully this is exciting to you as much as it for us. And any investment from my vantage point, and I'm an LP or an investor as a passive investor in many deals as well. Whenever I see the general partners providing a lot of the funds, B, they're taking in more risks, such as a recourse loan, and C, their returns are not just with acquisitions fees and all of that. It's actually built on the success of the project at the back end, which this kind of project does. That's what excites me, right? Because it allows me to know that everything is a business, and business has ups and downs, and things navigate over 3.5 years. It's a long time, but allows me to know that the incentive for the people who are working hard on this type of project is to make it super successful.
I'm super excited about this project, seriously. I mean, I can't wait, to get started on this construction of this. But thank you everybody for joining us today. We really appreciate your time, taking the time off over the weekend and check out this opportunity with us. And feel free to reach out if you have any further questions. But thank you so much. Thanks, Hemal, for joining.
Thank you, Vinki. Thank you for coordinating this.
Yes, of course. Anytime.
Appreciate your partnership. Thank you.